I'm going to go ahead and get started. Before we get started, I wanted to see, by a show of hands in the room, who here is a founder or a CEO that's also a woman? Okay, Tara, nice, love it. Well, hopefully everyone else is in the future going to be there. I'm Mary Osborne, Director of CX and Marketing for Tanner, which is a local independent accounting and advising firm. We work with the best and the brightest of Utah, and partner with them strategically to add value to their businesses. We have served on over 500 transactions with our M&A group, so we're proud of that. And we're proud of continuing our support of WeROC especially. Before I was at Tanner, I was at a VC firm for 9 years called Epic Ventures, did some other cool stuff, but the only introduction that I'm going to be using from now on is the one Tara gave me on our panel prep, which was that I am smart with a great sense of humor and a kick in the pants. So that's my favorite description of myself I've heard in a long time. So I sound like a movie with a good Rotten Tomatoes rating. So Tara also said funding won't dry up, but it will transform, and that's what we're going to talk about today. We have an amazing panel with a really diverse experience base and perspectives. And I know you're going to leave here with actionable perspectives that you can take on your journey with you as you figure out and navigate the whole capital world. I'm going to have them each introduce themselves and keep it brief just because we're low on time. But also give a picture of what you do and what your firm does within the capital stack that the audience is going to be engaging in.
Great. Well, thank you. Is this on? First up. Switch on the back. Oh, there we go. She really is just multifunctional. It's going to be incredible. Well, great to see all of you and meet all of you. My name is Olga Polonyana. I run private capital markets for JP Morgan's Capital Connect platform. Little known fact, JP Morgan, in addition to being obviously a very large financial institution and a leader in a large number of M&A equity and debt financing capabilities, 2 years ago launched a digital platform to help earlier stage companies raise capital than where we had previously been able to play. And I have the privilege of leading the equity private placement effort for that platform. So demystifying some of that lingo, what is it that I specifically do and what do we do? JP Morgan obviously does many, many different things across debt and equity. What Capital Connect does as a platform is we connect founders to funders. So we are a networking platform, a digital innovation platform, a data provision platform, and really all things data and connectivity for the VC and founder ecosystem for seed to pre-IPO companies. So very, very excited to be playing much more deeply and also much more digitally in this space from a transaction perspective and what we can do from a capital raising perspective already today. And obviously we have massive ambitions to expand our capabilities over time, but we're focused on primarily Series A through C, so deals between 15 and 100 million in capital raise, private placements, venture-backed, venture-backable companies raising from our wonderful colleagues here, as well as others across venture growth, family offices, and other institutional investors. So obviously happy to talk to you guys about that a little bit more, but I've been here at JP Morgan for 13 years. This is the most fun thing that I've been able to do after spending about 11 years in our equity capital markets and investment banking practice. So super fun to talk to you, and I will hand it over to the rest of my panelists.
Hey everyone, I'm Suze Duke, and as you saw with the mic magic, I am obviously a technology investor. So I work at Pelion Venture Partners. We invest in seed and Series A stage companies. We're located here in Salt Lake City, invest across the US, and we're investing out of our 7th fund, which is a $370 million fund. And we invest in software companies. I've been there for 5 years and love it.
Thanks, Suze. Hi, everybody. My name is Marie Peters. I'm the fund director with B-Side Capital and B-Side Fund. We are a nonprofit organization. We've been around since 1990, and we operate in Colorado, Utah, Arizona, and New Mexico. We primarily work with the small business administration loan programs, so we can do small loans under 150,000 for early stage businesses, all the way up to commercial real estate transactions up to 5 million. And so when you think about wealth creation, there's really two pathways to do that. One is business ownership, and the other is owning real estate. So that's where we play in the capital stack. I've been there for 11 years now, and also love it.
Thank you. So I'm Jeff Moss, and I kind of here on two different hats, I guess I would say. On the one hand, I help at USHE, the System of Higher Education, where I help to run a fund that's focusing around deep tech. How do we get more deep tech funded? How do we get really interesting research that either is spinning out of our universities that students are working on, or it could be corporations that are partnering in some way with our higher ed institutions. And so we create funding to help in that gap. That was something we identified a couple years ago that was really missing in the state of Utah. So that's the one side of it. The other hat is that I wear as I'm a state legislator. And I spend a lot of my time on the appropriation side. And we have a number of areas where the state is really wanting to lean into and provide funding for different areas of our state. So I'm going to speak a little bit about some of the funding opportunities there on the non-dilutive side. On the fund that I specifically helped to run, which Dave Karlbach's here as well. In the back, he's also a member of the fund. That one, actually, we do take equity investments, but we also have the option to do grants and loans and things as well with it.
That's great. Thank you, Jefferson. I like that version of your name.
All right, let's keep it.
So that kind of leads into the next question, and you can lead off with this, is just to talk a little bit more in depth about the types of capital that you deploy or help deploy and some of the differences. I know sometimes it's hard to remember what people do and don't know based on, having been in the business for so many years. So just describing the type of capital and what that means in each of your cases.
Yeah, so we'll start with the innovation lab. So that's the one that we dedicated for deep tech. And we are looking again, primarily looking at how do we get interesting things that are in that space out of the university. We could be putting $20,000 in a convertible note is one option, all the way up to $500,000 in an equity placement. So we're looking at a number of different things, and it really is a case-by-case basis. The way this fund was set up kind of in a unique way. It's not an LP fund. It was actually funds that came off of the Utah Fund of Funds, which was set up primarily to help bring more venture capital into Utah. And over about a 15-year period, it started to have these great returns. And I think in part it helped with a number of funds, like Paleon was an LP in that fund to help build the ecosystem. But what we see now is there's really a gap in the deep tech space. So that is a big part of it, is we're looking at ways that we can put capital to work, even early stage deals. On the other side, with the state funding, there's a number of opportunities, the SBIR, STTR, where you actually can apply for these funds if you are trying to go through some kind of clinical trial, or you're trying to get a grant or something like that. These funds are available to help kind of bridge that gap as you go through that process. And these funds all actually are run out of the GOEO, the Governor's Office of Economic Opportunity, so that you would apply. What's interesting, speaking to this demographic, there actually are some incentives for women. We want to see more women entrepreneurs. We know that there's a huge need in that space. So there actually is additional funding available for you if you're interested. So you can just go to the GOEO website and get access to all of those different types of grants.
Great. Thank you so much.
And for us, we're debt, right? So this is not an equity investment that you'd get in exchange for ownership. It's a non-dilutive tool where you borrow funds, and we do everything long-term. So if you're borrowing money for commercial real estate, that's going to be on a 20-year or 25-year term. If you are looking for a working capital loan, whether it's under the SBA 7A loan program, again, goes up to $5 million if you're working with a bank. The way we fit in is we help that bank through that process to be able to do that SBA loan. And then we do those smaller dollar loans. So we go up to 10 years for those debt vehicles as well, for 150,000 and below. So unlike equity, where you have to give up ownership, this is understanding what you're borrowing, and you have a specific monthly payment that you pay back whatever that investment is. And so you keep the ownership of your business when you utilize debt as a tool.
Thank you.
So Pelion is a venture capital firm, so we are giving, equity, dilutive capital. So typically when we invest, we take somewhere between 10 to 20% of the company with our investment. Um, and I think what's important to know for venture capital is that, not all business models fit the venture capital investment. We're looking, Pelion is investing out of a $370 million fund. We're looking to invest in companies that can at least return our fund. So that means that your market cap has to be, multiple billions, and that we hope that your valuation eventually becomes multiple billions to invest in. And that's just the reality of venture capital investment. It's not necessarily true for like family offices and stuff like that. So you don't, like, if you're building a business and it's a smaller market cap potential, then don't count family offices out. They make different investments than venture capital firms. But for a venture capital firm, that's pretty typical. So it's just something that's good to know.
Thank you. So my practice largely overlaps with what Sue's just mentioned, except just very slightly later stage. We probably overlap a little bit in the middle. But 70% of what I do is advise companies on anything between Series A and C, which would be either venture capital or growth equity investing. Similarly, around ballpark, the total investment amount could be anywhere from 20% ownership in a company to 50% ownership in a company, depending upon the specific terms, valuation, and what the investor is taking. 90+% of the time, they are at least start life as what we consider to be a vanilla venture capital growth equity deal, which would be a convertible preferred instrument, which has a particular valuation, which therefore carries a particular level of dilution, as well as a number of terms that Sebastian, my Omni colleague, went through earlier today, including liquidation preferences, dividends, and other specific terms that investors want. But the way to think about most convertible preferred transactions is it is very close to equity. There is a dilution element, but also much of the time a Series B will be senior to a Series A in a cap stack. Series C will be senior to a Series B. So it is a little bit in between traditional common equity and a debt instrument. So that's probably 50 to 70%. A lot of time, particularly in the turbulent market that we're experiencing today, things start life as something that is not necessarily where they end up. And so when we go to market with our clients, what I would do is I would be advising the company. So my client is always the company that is raising, and we go out to market and we reach out to any number of venture capital, growth equity, family office firms that we think might be relevant to a particular transaction, and we solicit their feedback as to what type of deal they might be interested in. And so again, sometimes that does end up being a 10 to 20% dilution Series A. Sometimes people come back and say, actually, I'm willing to put some debt on the company, or I'm willing to give a higher liquidation preference, or I'm willing to give a higher dividend. I'm just not comfortable with the traditional structure. And so then we obviously advise the company on what might be the best course of action given those different options. So my job really is to advise, sadly not quite to deploy, but to compare and contrast options and give my companies the best outcome that they can get.
Thank you. And we don't have to go down the line, but just talking about what types of profiles for businesses and entrepreneurs fit these different types of capital, and then what is the timing on a relationship building to get going on those types of relationships?
I'll start super briefly and then hand it over to whoever wants to go. But our minimum criteria for my business very specifically is for you to have $3 million in revenue and a growth rate of 100%, which is what we believe fits many VC profiles at this stage. Or if you're a larger company, so 20 plus million in revenue, maybe more like 50% growth rate. So that is the typical profile of my companies that are my clients. They could be raising anywhere from 15 to 100. Obviously, a number of different profiles also can apply, and we can consider how we can best help. Relationship building, look, the earlier, the better. The earlier you get to know the bankers, the better we can give you advice on how to position yourself, when you should actually go to market, what are market conditions like, how do you think about reaching out to investors, what should you do. Again, remember, I don't deploy capital, so there is very little downside to telling me a version of your story that you may not be fully comfortable going to market with. And we can provide you feedback and make sure that by the time you are ready to talk to people who can write a check, your story is a little bit more polished and you're really ready. So call us early and often, and we will advise. But I'll defer to others on your perspective as well.
For us, for Pelion, we invest at the seed and Series A, so it's anywhere from a PowerPoint deck up to a couple $1 million in revenue is typically where we would invest. Um, and um, and like I said, I already gave the criteria of like venture backable because otherwise, it's just not interesting to us because of the way our fund works. As far as like making connections into a VC fund, I'd say like what you just said is reach out early. For a VC fund, I'd say it depends. There are advantages to like how you want to tell your story. And if you come too early and you don't have things figured out, there might be disadvantages in like telling a story that's not fully thought out. Because at the end of the day, that's what you're doing with a VC fund is you're telling your story. And um, but I'd say like what matters is getting a warm intro into a VC fund. Get someone that like actually knows the people well and figure out which VC fund matches, like the type of company that you're building, the right stage, because getting an intro at the wrong stage, it just doesn't help you at all. So figure out the VC fund and then find someone that can give you warm intros. Cold intros work sometimes, but most of the time the email or the LinkedIn reach out just goes unnoticed. So getting a warm intro is huge. And then from there, it's, preparing your pitch and everything else. But warm intro, that's my advice.
On the debt side, for businesses, you probably already have a relationship with a bank, right? Wherever your depository relationship is, whether it's on your personal accounts or your business accounts. We always recommend that you reach out to your bank first because you're going to already have that relationship. When we think about raising funds for working capital for operations, our programs are really designed if you're unable to get financing from the bank already. So again, we work with a wide range of lenders, and so that's where we get referrals if they're not a fit for the bank for whatever reason. I would say that our application process is probably 45 to 60 days. If you're doing commercial real estate, depending if it's an existing business or building or ground up construction, that can change the timeline as well, 3 to 6 months. But again, if you are working on a big long-term project, reaching out to us early so we can kind of understand what you're working on and help give advice and walk through those steps. Or maybe you don't have a banking relationship that can take on your request. Because we have so many relationships with lenders, we can try to help matchmake as well, depending on what you're working on.
So I'll start first with the non-dilutive side. So on the grant side, what the state cares about, what we put funding toward, varies from year to year. Right now, I'll tell you, with COVID, we had some serious concerns about supply chain issues. And so I was one of the House sponsor on the bill, but to do a manufacturing monetization grant. And that was available to anybody. You could be a startup, you could be a massive company, but you had to prove that you were going to be able to bring your supply chain more onshore and be able to solve some of the problems that we were seeing. So for a period, that was a pretty critical need for the state, but that was non-dilutive funding that you could go and just get as a grant. So I would say look at that. The other is rural. We have so many people that are building amazing companies along the Wasatch Front, but we have an area outside the Wasatch Front that is really struggling. And so there's a lot of incentives right now. If you're willing to locate your company off the Wasatch Front in a rural area, there's a ton of money out there for that. And if companies are willing to do that. So those are some of the things that are on the non-dilutive side. On the fund side, we're kind of unique. We don't have to hit an IRR. We actually are not technically a fund in the traditional sense that we're quantifying the return based on X dollars in, X amount out. We're really trying to invest in things that could change the world that really right now there's not a market that's willing to put funds into. So it's really almost more of an economic development effort. But at the same time, we think like VCs. We all have a VC background. We're getting insight from VCs and our industry partners as we're looking at these really early, interesting things that are spinning out. Some out of universities or businesses partnering with, maybe it's a student that they're working with. That's kind of the nexus we have to have. But for us, we're actually willing to look at something that's much earlier, but we're looking more at the fact, can this potentially change the world? That's really what we're looking at. And I think that's where the state's willing to put resources in when otherwise a fund may not be willing to put that kind of capital. And it's patient capital. We're not looking for, we don't have to hit 7 to 10 years to get an IRR. We actually are okay if it takes a longer time, if it's really going to make a difference in the world.
Great, thank you. I wanted to get your perspectives on what themes you see emerging in Q4 and then next year within your respective capital stack.
I guess we'll just keep
Yeah,
going
yeah.
back down and forth. Yeah, I'm not as active in the VC space as I used to be, or in the bank. I worked in banking and in VC before. I do know that it is a more difficult environment in some cases, is what I've seen. But like we always see, and even in really tough environments, good companies always get funded. That's what I've seen.
I would say for outlook, obviously we're in a high interest rate environment right now. For those keeping count, we've seen 11 hikes in interest rates from the Fed since March 2021, and excuse me, 2022. And so we do expect that rates may continue to rise as the Fed continues to fight inflation. So with that, we are seeing some tightening of credit with banks and the debt market. And so what does that mean? That means fewer businesses are probably getting approved for loans, and there's going to be lower fundings. So checking out alternative lending sources, again, SBA loans are a nice tool for that. In fact, they're kind of counter-cyclical because it helps banks do loans that they can't approve on their own. My advice would be, explore all the different options, be very informed, be willing to be creative, to be able to fundraise and get all those different capital sources in your stack.
Really quick on that, we chatted about in our panel prep that only 14% of the capital deployed by the SBA goes to female entrepreneurs. Are there any special programs or any ideas to give on ways that we can help raise that? Or
Yeah, thanks, Mary. Yeah, when I heard the statistic, I was like, whoa, that feels very low. And so I dug into it a little bit more. It was really interesting. So when women-owned businesses are starting businesses, there's a great Kauffman Foundation study. They're a group out of Kansas City that does a lot of entrepreneurial studies. And they said that about 90% of women-owned businesses need financing. But what it also found is that 54% of businesses that need financing choose not to apply. And when you dig a little bit further on why they're not choosing to apply, about half of them are debt adverse. 11% think the application process is too complicated. 8% think that the cost of the capital is too expensive, which makes sense right now with rates being so high. But the one that kind of jumped out at me is 1 in 4 don't apply because they're already expecting to be turned down. So when I think about how we can change that, it's groups like Connect Capital that are doing the education, providing the resources, and so people can learn about the different options so that they feel confident enough to actually even go for it. Because that's the only way that we're going to be raising those numbers on the capital that are reaching women-owned businesses.
that's great, thank you.
So I'll talk a little bit about what some of our portfolio companies are seeing as they go out and raise, and what I'm seeing in my seat, and then kind of forward looking. So today, what we've seen is seed and Series A. Really, any private capital raise is really difficult right now. less companies are getting funding, and the funding amounts are a lot smaller than they have been. It's probably gone to like the actual historical average. It's just 2020 and 2021 kind of bumped up expectations to be kind of crazy, and now we're back to like something more normal. Um, but that said, like even historical averages, like we're down on deal count and dollars invested um, at seed and Series A. And I would assume that's true even worse at the later stages, because I know how much harder it is for some of our portfolio companies to raise at this C plus levels, B plus levels, really. Um, right now, you have to almost be exceptional to get funding. It's not even like good companies get funding. It's like great companies get funded, and good companies have to do internal rounds and hope that like market conditions get better. What we've seen is like the private market usually follows 2 quarters behind the public market. And so this is all assumptions. I have no idea what's going to happen in the future. But what we've basically seen is as interest rates have risen, that's lowered the deal count and deal volume that has been invested at the private levels. As those have kind of like leveled out a little bit, you've seen public markets start to rise. And so we assume that like that will impact the private markets in a quarter and maybe 2. So hopefully it gets a little bit better for the private markets. And I would assume that it does as the public markets get better. But honestly, who knows? So
Well, the JP Morgan crystal ball is about as good as anybody else's, which is to say not that great. But look, trends in private capital markets, everyone's quoted the statistics. We're down 40% year on year, 23 versus 22. We're down, I'm sad to repeat Sebastian's stat from earlier, 85% relative to the peaks of 2021. But to Sue's excellent point, we're actually right around the 2018, 2019 deal averages. So it really just looks terrible if your rear view mirror is about 2 years old. If you're actually extended, it really is not that bad. But what's happening is, right, venture capital funds and private equity funds and growth equity funds, 2 things have happened. One, venture tourism, which is an amazing term that somebody coined, has all but disappeared, right? So all these late stage funds and crossover funds and public funds that were dabbling in early stage and mid stage venture capital in 2021 because you couldn't get any yield in the public markets, they realized in 2022 and 2023 that one, public equity markets are now vastly cheaper, and so you can actually invest there. And 2, they don't actually understand exactly how to invest in venture because they don't have a history of doing so. And so they have pulled back massively. And so that obviously mainly affects the pre-IPO rounds, which are down 80+% versus the seed Series A, Series B, which maybe is down 40-50%. So certainly much deeper effect in the later stages than the earlier stage, but less venture tourism, less just capital available to deploy. But the core market, right, the core venture specialists, the core growth equity funds that have always invested in this market are there. They have raised billions of dollars of dry powder in that 2020, 2021 vintage era. They will need to deploy it sooner rather than later. Everyone's investment committee is saying only invest in the best of the best. There is no benefit to you investing in Q2 2023 versus Q3 2023. So just hold it. Hold it. And that's why people are making 1.4 investments per quarter instead of 4.1 investments per quarter that they were doing 2 years ago. But nonetheless, they're sitting on dry powder. They will have to put it to work sooner rather than later. And so, one, as founders, you now have to call a lot more people than you used to in order to get your check writer, in order to find that one firm that's going to say, you are great. You fit my investment profile perfectly. So just keep calling and just keep getting those no's until you get to a yes. That is one piece of advice. 2 pieces of advice, get ready for a long process. Start earlier than you need the capital. be ready, make sure that you have cash runway for not just 4 quarters, but preferably 6 quarters, maybe even more, so that you actually have the time to do it. But hopefully the world will get better in 2024 and people will want to put that capital to work.
That's great. Thank you. And that kind of leads into my kind of the last that we'll close this out with is just your best advice for entrepreneurs at kind of a bit of an earlier stage for getting ready to look towards, as you just did, look towards trying to secure that type of capital. And what kinds of things do you need? Do you need to hire a pitch deck person? Do you need to hire a marketing or a consultant, or just your best advice for the entrepreneurs in the room?
Woof. We'll do like 3 words: prepare, practice, and I'm going to steal Suze's warm intro.
Warm intro. um, no, I think your story matters so much when you're pitching, especially at the earliest stages. Like you are pitching a vision and a future that you're trying to like help the person that you're pitching to see. So practice a ton, get feedback from others. And I'm like happy to give feedback to people if you want to reach out to me if you're starting a business. And get a warm intro into the firm that you think is a good fit for you. But yeah, just practice that vision so much at the earliest stages. And then at the Series A, you've got to show that it's working. And it's like vision plus it's working. So yeah.
I would say solid financials, projections, really building that business case. And again, I said it earlier, be creative, be informed, and talk to as many people as you can.
My advice is going to be talk to Suze. Apparently, that's the seriously that is the best help you can get. Talk to somebody who's in the industry that understands what before you go in and throw yourself out there. Get some one-on-one feedback of, is this really going to resonate? Do I really have a problem I'm solving that's worth them putting their money in? And I do think networking. I mean, going to events like this. I was once upon a time an entrepreneur, and it was really helpful for me having people to lean on and ask questions and then get introductions. I think that's huge.
That's great. We have 2 minutes left. Does anyone have any questions? It's late on day 2. Yes.
Yeah. For a 5-minute pitch, no matter what the length is from start to end, the whole thing is the story. Whether you're talking about financials or whatever it is, like you are building a story up, and it should make logical sense from beginning to end. You're building up the problem. This is a huge problem, and then you're building up like your background and the solution, that it's the right solution for it, and you've already proven that it started to work. Like the entire thing is building up the story, but yeah, like start to end.
Anyone else?
Yeah, I think one thing I would add is, especially if it's a 5-minute pitch, there are probably like 3 specific numbers that matter, maybe 5. So, one, know what they are for your business is going to be different for every single one, depending on the stage. Like, if you don't have revenue, maybe you have customers, maybe you have clicks, maybe you have number of products, maybe you have something, but you're going to have those 3, 4, 5 stats that tell your entire financial story. And my best piece of advice for a founder is make sure you know what they are and make sure that they come out in the first 5 minutes of however long your pitch is. If you don't have that, you're going to lose everyone's attention.
Yeah, actually, if I was going to add like one more piece of advice, it would be know your business model and everything about your sector and your business better than anyone else in the room. You have to. If like you're asked a question and you don't know what like customer acquisition cost means, then like all of a sudden you lose part of your credibility. if that matters to your business model. So just know your business better than anyone before you pitch.
Okay, that's time. Thank you all so much.